I'm comparing 6 Canadian banks today, their performance over the last year, and we're going over all their ratios coming up. What's up guys, welcome back to the channel. My name is Sean. If you guys are new here, as always, please consider subscribing if you're into personal finance and investing topics. I'm covering my journey to financial freedom, and today I got a follow-up video for you guys on one that I did earlier in the year that covered the five big Canadian banks plus Canadian Western Bank. I went through a bunch of ratios on that video, kind of see how those banks were doing because I was looking at building or starting a dividend portfolio. I thought now that all the Q4 results are out for 2020 and it's been a very interesting year, I've taken that table that I shared before, I beefed it up a little bit, added a little bit more detail because I thought there would be some extra stuff we want to look at for these banks now that we want to look back at 2020. So anyway, let's get into it. I'm going to start by going through each one of the banks. I'm just going to do a high level reintroduction of what each one was. Then I'm going to put up the table. We're going to go through the ratios and talk about those as well. So let's do it. All right, so I'm gonna put my bullet points up on the screen here. So Royal Bank is the first one that's up. So very brief overview. Royal Bank, one of the big five. It's been growing its dividends since 2009. It's a very diversified portfolio compared to the rest. I mean, all of them are pretty diversified, but Royal Bank is especially. Its personal banking was down this year, but the capital markets end of its revenue helped it do well. So 40% of its revenue also comes from outside of Canada. Now, most of their money comes from wealth management, capital markets, and RBC also does insurance. So it's worth noting that that's what did well for them this last quarter. One other thing I'll talk about for all the banks right now, especially during a tough year like this one, is their exposure to vulnerable markets, which is basically how much money they've loaned out to businesses that are in vulnerable markets. And a lot of people are really thinking about oil and gas when we talk about this. Oil and gas has had a rough year, hasn't had as much coverage as it probably normally would just due to everything that's going on. So there is some stats for exposure to oil and gas in vulnerable markets. I'll compare those across all the banks. But yeah, 5% of Royal Bank's portfolio is in vulnerable markets right now. That's a relatively small number, but it's worth comparing this stat with other banks. So that's Royal Bank. Let's jump into CIBC. CIBC, dividend growth since 2011. This one is mostly made up of personal and commercial banking. It does have a little bit of exposure to US markets. It's had slight improvements from the previous quarters, and it's basically had kind of slow growth. It's got about 2.2% of its portfolio in oil and gas and vulnerable markets there. Now, one thing to remember for CIBC is it's typically known for having a lot of exposure to mortgages. So at the start of the pandemic, there was a lot of uncertainty about CIBC because we weren't sure if people will be able to pay the mortgage. Of course, things have changed since then. So, but when you think of CIBC, think of that as well. That's kind of what they're known for. Next, let's jump to TD. TD's got dividend growth since 2010. It's the most American of the Canadian banks, and then it has lots of exposure to US markets, so was hit quite significantly when there were a lot of these rising cases and numbers in the US for COVID cases. Now, it's also had the biggest comeback or improvement from Q3 to Q4 of all these banks because, well, that economy has been doing pretty well the last couple months, or I should say it's bounced back. So that's showed up in TD's balance sheet as well. A lot of that had to do with the selling of Ameritrade. That bumped their revenues significantly, but that's not something that's going to be repeated from quarter to quarter. So it's important to think of that if you're looking at their sheets and looking at why they had such good revenue this quarter. The retail revenue was down by 2% in Canada, down 8% in the US, and 6.4% of TD's loans are out to vulnerable industries. So that's something to note there. That's TD. Let's jump to BMO. BMO's got dividend growth since 2012. Its biggest revenue increases were from its wealth management section, which is basically selling investment products. The capital markets also contributed well to its revenue increases. It's got that 5% exposure to vulnerable companies, and it's looking to reduce or completely eliminate its oil and gas. I would say reduce its oil and gas, the amount of oil and gas that's in its portfolio right now. Most of the loans that it has are also tied to mortgages and large commercial ventures. Bank of Nova Scotia, this was one that I missed on the original video. I made a separate video for Bank of Nova Scotia because a lot of people really requested it. I've included it this time so that it's part of the comparison. Dividend growth since 2011. It's the most, we'll call, international bank. It's got exposure in Central and South America. However, that hasn't played well in its favor because a lot of those countries have not been dealing well with the pandemic. So that actually hasn't worked in Scotiabank's favor. So just something to note there. When you think of Scotiabank, think of the most international of these banks right now. It's got 4% exposure to those vulnerable industries as well, including oil and gas. And finally, the smallest of all the banks, Canadian Western Bank. I threw this one in because it's one that operates in my region. This only really operates in BC and Alberta and a little bit in Ontario. It's actually looking to expand in Mississauga right now. It's had dividend growth since 2016. And here's the surprising thing. Its exposure to vulnerable markets is actually the least of all the banks. You would think that a Western bank would be highly exposed to oil and gas, but looking at their Q4 presentation, it's actually less than 1% of its portfolio, which is was pretty surprising to me. Okay, so that's the run through or kind of overview of all the banks. I'm gonna put up my spreadsheet here and we're gonna talk a little bit about the banks, their ratios and how they compare with each other. A lot of information, I'm gonna post it up, but we'll walk through it chunk by chunk. It's important to note that the numbers I've posted here are some are in millions, most are in millions unless otherwise stated. Market cap is in billions. The stats for the stock price are as of the recording of this video. However, the ratios will be from the Q4 report, especially the CET1 ratio and provisions for credit losses. Then I'll get into the third chunk at the bottom, which is a bunch of dividend information. And the yields are based on the current stock price as well. So right from the top, I've listed for you the ticker symbols, as well as stock prices, market caps, RBC being the biggest bank, all the way to CWB, which is the smallest, and the earnings per share are all listed there for you to compare. Now we'll jump down into the second section, which is the ratios. I've color-coded these, but I'll explain a little bit to walk you guys through this. Some of these are in red, but it's not necessarily a bad thing. Now, price to earnings ratio, all of them are in the same ballpark. The average P to E that you're looking at here is about 12.53. So you can see that maybe Scotia and CWB are maybe below average. You would look for that, whereas the other three are a little bit higher. However, normally look for price to earnings ratios of below 25 in a normal situation anyway. So all of these are pretty good. They're in the same ballpark. Nothing that you would really pick out here. Price to sales ratio. Normally we'd look for a number that is 3 or less. We can see that most of these are under 3, which are in green. TD Bank is just over 3, but it's not something I would eliminate TD Bank over. And RBC is a little bit higher than that, but again, they're in the range. The average that you see for the, I'll call it the industry, but the banks you see in front of you is 2.77. So the bank that is the lowest below that would be kind of your BMO and Scotia, are probably your best deals there. Price to book ratio, you look for 5 or less typically here. All of them are in a good range. The one that is kind of really good, under 1 being excellent, is the CWB. Now, operating margins, I've listed all the operating margins here, but what you look for here is whether an operating margin is increasing or decreasing. All of these operating margins have decreased, which is not a good thing. However, it's kind of across the board. And so again, not really being able to eliminate one bank over another over this. But you can see that CWB has the highest operating margin. It's worth noting that CWB makes most of its money off of interest. So that's a big factor in that. Now, here is a ratio that I didn't talk about before, which is the CET1 ratio. What this ratio is, and you'll notice if you try to go into the Yahoo Finance pages and try to pick out a current ratio for these banks, is that you don't get one. And well, what's a little bit different about banks is that their debt or loans is actually considered an asset, because these are contracts that they've made with, whoever. Consider your mortgage, right? You're signing a contract with the bank to borrow some money to buy a house, and you pay interest on that money. So for the bank, that's actually an asset. For you, it's a liability, but for the bank, it's an asset. So what the CET1 ratio is it helps you differentiate how much of their assets are not tied up in contracts. So it's like how much of their cash is liquid versus what's tied up in a contract or a loan to someone, which is more difficult to get. So what you want here is a higher number, especially in tougher times. You'll see, again, TD Bank has the highest number here, followed by RBC. All of them are around 11 to 13%, except for CWB, which is 8.8%. So that would lead you to assume that the big 5 banks are in a little bit of a better position, cash position, than CWB. Now, the PCL, I gotta explain this one because I didn't know what a PCL was until this quarter, because it was reported by all the banks. I was sitting there feeding my son one morning watching BNN, and I see them post these couple of graphics for some of the banks reporting their quarterly statements and talking about PCL. I had to go back and figure out what this was. So PCL is provisions for credit losses. And what that means is how much cash the bank has set aside in order to be able to pay for contracts or loans that may not be able to pay them back. So it's essentially kind of protecting themselves against defaults and foreclosures and that kind of thing, where their customers are not actually able to pay back their loan. Now, the reason this is important is because you want to make sure that you have some of this on the side in order to weather the storm like we did in 2020. But the other thing is, when you see banks adjust this number, it gives you an idea of their outlook on the economy and where they think the markets are going. So across the board, again, here, you can see that all of them have decreased. I'm not so concerned about which one has decreased the most over the rest. However, it's important to note that they have slashed their provisions for credit losses across the board, which means that banks' outlook right now on the economy is turning more positive. They had put money aside earlier in this year, but the way that they're looking at the markets, the way that they have communicated with their customers, it's sounding like things are going to be okay, and customers will be able to pay off their loans. So that caused the banks to say, okay, well, we don't need to set this money aside then, and have a more positive outlook on the future. So that's a really good thing for the markets in general here. When the banks are confident, that raises investor confidence as well. So that's the biggest thing there. Now, the last stat is the exposure to vulnerable markets, and these are all expressed in a percentage of the total loan. So this is like in dollars. You can see across the board here, TD Bank with the highest exposure to vulnerable markets and CWB with the lowest. These are still not huge parts of their portfolio, so I wouldn't be too concerned, but again, it's worth noting the highest and lowest in the range here. Now, for those of you who are interested in these companies because of the dividends, this last section here, I've kind of laid out the dividend statistics for you. So the dividends for each stock listed at the top. The yield now, as you can see, is a little bit different from where we were 6 months ago. So the highest yield being Bank of Nova Scotia, which is 5.3%, and the lowest is CWB, which is at 4.07%. 4.59%, in case you're wondering, is the average across all of these, and that gives you BNS and CIBC as your top 2 pick. I hold a little bit of Royal Bank, a little bit of CIBC, and CWB as well, just as a little bit of a mix. But again, these are pretty nice numbers, pretty healthy, but a little bit lower from the 7% and 8% we were seeing earlier in the year when their stock price was low. Now, the other thing you got to look at is their free cash flow per share. You want to make sure that there won't be any concerns from the bank when they go to pay this dividend, and what you want is the FCF per share to be more than the dividend. And if it is, it's highlighted in green here, and that is the case across the board. So there should be no concerns about these banks paying out their dividends. The payout ratios as well, you'd like to see things under 60%. That was not the case 6 months ago. However, things have turned around again this year, and all of these are under 60%, the lowest being CWB. So again, nothing here to indicate that you won't be getting your dividends. And finally, I've also included the dividend streak, is what I call it, and that is the number of years in a row that the dividend has either stayed the same or increased. All of these are really good numbers. You can see that 4 of these banks have 25 plus years of dividends staying the same or growing. Now, I don't want to confuse you guys, but earlier in this video when I was saying, let's say that one of the banks was growing since 2011, that means that they have raised their dividend every year since 2011. However, this stat here shows you whether they've raised or kept it the same. So that's the difference. I just don't want to cause confusion there. But these are all, again, very safe, very good numbers for people who want to build a dividend portfolio. If I had to make a pick, I'm quite partial to CIBC just because it performed so well for me this year. And you may even want to mix a few of these up, sort of like I did. CIBC gets you a little bit of US exposure, so does TD, gets you a little bit more. BMO has a little bit of US as well, but I'd probably try to mix in the Bank of Nova Scotia with that too. And you know what, if you like all of these, look for a ETF that contains all these banks, and you know what, you don't even have to worry about it. Now that's all I have for you guys talking about the banks. I wanted to say thanks one last time. This is going to be my last video for the year. I'm going to start to revamp the YouTube channel a little bit. We have to get into a few things in the coming year, in the next season we'll call it. I still owe you guys a video on defined benefits versus defined contribution plans and company stock plans, talk about those. We're trying to break the 900 subscriber mark and jump to maybe even 1,000 subscribers early in the year. When we do that, unlock more of my net worth. We'll talk about more money management themes, and we'll keep doing reviews either quarterly or every 6 months on these banks, and keep watching some of these staple dividend stocks. We'll talk about Canadian telecom companies. We'll talk a little bit more and see how Airbnb is doing, and DoorDash and some of those big tech companies that came out this year. There's just so much to do, so many video ideas, and I'll try to squeeze them in, but really appreciate it, guys. I don't want to make this video any longer. Thank you for a great 2020. This channel has grown like crazy, so thank you everyone who subscribed. I started out this year with like 34 subscribers, and we're almost at 900, which is crazy. So thank you guys for a great year. Have a great holiday, have a great rest of your year, spread the wealth, and I'll see you in the next one. Bye.